talking about ratios. Now, ratios are information gathered from the financial statements, the quarterly and the annual statements. And basically what we're doing is we're taking the numbers on there, dividing, multiplying, and basically combining them together to get a result that we can compare to previous quarters and to other companies. The reason we want to do this is so that we can analyze these companies and decide which ones we want to invest in and how we can measure the performance of that company over time. So the first ratio that we're going to look at is the net profit ratio. It's very simple. It's the net profit divided by the net sales. And it's basically a measure of the efficiency of a company at turning revenue brought in into profit that they can give back to shareholders or use as an investment into the company. Now, as an example for this video, we're going to use Apple because we've looked at their financial statements in a previous video, so they're easy to understand, and because they're fairly simple and straightforward, and they apply to all the ratios we're going to look at today. So when we look at Apple, we can see that they did $22.2 billion in net profit, and they generated $91.8 billion in net sales. When we do the math on that, it's really simple. It's 22.2 divided by 91.8, and it gives us a 24.1% net profit margin. Now, I got all of these numbers from their consolidated statement of operations, or basically their income statement from the last quarter. And as you can see, I've circled the numbers here in green. So 91.8 billion in net sales, 22.2 billion in net income. And these are the numbers that I'm using to generate the net profit margin. And this is the basis and the metric that we use to analyze how efficient is this company at bringing in money and turning it into profit. So really simple. I got this one right from the last quarter's financial statements. The next ratio that we're going to look at is the price to earnings ratio. It's basically saying, how much profit did this company generate, like the last one, and how much is that stock worth comparatively? So if we have two companies that generate the same amount of profit, this is the metric we would use to see which one's at a better price and at a better valuation in comparison to the profits that they generated. So really simple, it's just stock price divided by annual earnings per share. Now, when I say earnings per share, what I mean is the net profit on an annual basis divided by the number of shares. So if your company generates $1,000 and it has 100 shares outstanding, 1,000 divided by 100 would be $10 in earnings per share. Simple math is just earnings of the company divided by the number of shares. And we're looking at this on an annual basis. And we're also looking at the stock price on today's price. So the reason we look at this is to show the relative price compared to the earnings so that we can see which one's a better deal if we have two companies that are giving us roughly the same earnings. When we look at the comparison of Apple, we can see that their price today is $278.58. Their annual earnings per share based on the last 4 quarters is $12.66. So all I've done is taken the earnings per share in a quarter and added them up for the last 4 quarters to get the annual earnings per share. And when we do the math on this and we divide the stock price divided by the annual earnings per share, it gives us a ratio of 22. Now, I pulled this information from the same sheet as the last ratio. It's located at the bottom. You can see earnings per share, basic and diluted. Now, the only difference here is basic means all of the shares that are actively traded in the market, and diluted includes the shares that are given to executives that can be exercised at a later date. So for instance, if an executive gets a bonus or an incentive structure that says you can have 100 shares 1 year from now, if you hit X target, you get it at this price. That would be a share that isn't in the market yet, but can be exercised. And it would be included in the diluted number, but not the basic number. So we always want to use the diluted number. And to get the annual earnings per share, you're going to add this number up for the last 4 quarters. And then you're going to divide the stock price by that total. In this case, it was 278.58 divided by 12.66. And it gave us a ratio of 22, a PE ratio of 22 that we can now use to compare to the last quarter, the last year, as well as every other company in their industry that we're evaluating of whether or not to buy the stock. Next one that we're going to look at is the current ratio. This is really simple. It's just the current assets divided by the current liabilities, and it is a comparison and an analysis to see, can this company cover its short-term obligations? Does it have enough cash in the bank to cover the expenses that are going to come up within the next year? So it's basically saying, can the company survive, number one, and two, how well is it positioned cash and assets wise to cover the short-term obligations that are going to come up over the next year? The math is really simple. Current assets divided by current liabilities. So when we look at Apple, we see $163 billion worth of assets on their balance sheet divided by $102 billion worth of liabilities on their balance sheet, and it gives us a current ratio of 1.59. You can see those numbers identified very clearly here on the balance sheet. 163 billion divided by 102 billion gives us 1.59. It means that Apple is in a great position to handle all of their liabilities and expenses over the next year. And if we compare this to the other companies, we would be able to see how well they're positioned relative to Apple, for instance, Microsoft, Amazon, Google, any of the other tech companies. So you can also do this with the long-term liabilities and assets, but generally it's concerned with the short-term liabilities and assets just because it's on a one-year basis, so it's a little bit more of a sensitive ratio. The next one we're going to look at is the dividend yield. This one is extremely important for any dividend investors, long-term fundamental investors, and anybody looking for cash flow. It's also one that Kevin O'Leary and Warren Buffett really focus on because they are all about cash flow. So the way it's calculated is really simple. It's just dividend per share on an annual basis divided by the price per share. So the price per share is really simple. That's the price it's trading at today. And the dividend per share on an annual basis is just the sum of the dividends that are paid from that stock in an entire year. And the reason we look at this one is because it analyzes how large the dividend is compared to the price that we're going to pay for it. So if we buy a stock for $100 and it gives us $5 in dividends, it has a 5% yield. It gives us $1 in dividends, it has a 1% yield. If the stock was $200 and it gave us a $10 dividend, it would still have a 5% yield. That's the basic math here. And it's basically saying, if I invest X amount, how much money am I going to get back? And how do I compare that between these companies? Which one's the best in giving me the most money back? That's what we use this ratio to figure out. When we look at Apple, we can see that they pay a 77-cent dividend per quarter. That means that they're giving out 77 times 4 on an annual basis, and their current price is $278.58. When we do the math on that, it's 77.77 times 4 divided by 278.58, and it gives us a total of 1.11% yield. That means that Apple is paying back 1.11% of its stock price to its shareholders in the form of a dividend every single year. Now, that's a very low number. It's not a big number, and it's because Apple is a tech company that invests most of its money back into itself instead of giving that out as a dividend. That's why it's been able to grow so quickly since its inception. When we look at the numbers, this is the statement. Shareholders' equity is located right below the balance sheet. And you can see here, dividends and dividend equivalents declared per share is 77 cents for the quarter ended December 28th, 2019. So Apple paid back 77 cents in the last quarter. You multiply that by 4, that gives you your annual dividend. Divided by the price of the share, it gives you your yield. If they paid back much more, that yield would be much higher, and you would get back much more cash on an annual basis through your dividends. That's the idea with dividends, is the cash flow basis of the money coming back to you. And this ratio helps you determine which one is going to give you the most cash back as that dividend based on the amount of money that you're going to put in. So in summary, ratios help us to compare companies and understand their performance over time. We're going to look at 5 different companies, all from the same industry, and we're looking for the highest dividend. I'm going to compare these 5 companies, and I'm going to look for whichever one has the highest dividend yield. That's the one I'm going to pick. It also helps me look at their performance over time. Has that yield gone up? Has that yield gone down? And which way is it trending as well? Ratios are specific to their industry, though. So when you look at Apple, you want to compare those ratios to other tech companies. Don't want to be comparing them to an oil and gas company or a solar company or something completely different, because the ratios won't make sense and they'll be very off. You want to compare company ratios when they're in the same industry. That's how you analyze a market and decide which companies to get into. So you choose an industry and you choose the best company that fits your risk tolerance and your goals. The one thing you do need to realize, though, is I've only explained 4 ratios here, and I've done them on a very summary basis and only scraped the surface. There's a lot more detail in each one of these ratios, and there are also hundreds more ratios for you to look at and understand. The key here is Know the big ones, the ones that I've gone through, and maybe a couple of more that you should learn, and then focus on the ones that are specific to the industries you want to get in. If you're in a tech industry, you probably want to focus on growth. If you're in an energy industry, you probably want to focus on the operations and the dividend yield. If you are in a medical or bioceutical company, you probably want to focus on different ratios than earnings. Because they're not going to have any earnings, they're developing their technology. So the big thing here is you want to focus on ratios that are applicable to the industry that you are trying to get into, because there are hundreds of different ratios. There's hundreds of different calculations. Focus on the big ones, know a couple or more, and then focus on the ratios that are specific to the industry that you want to get into, that will give you the clearest and most identifiable information to make an accurate trade on. If you have any more questions, send me an email. We're going to dive into this a little bit more in the next couple of videos, so definitely stay tuned.